All right, team. So this podcast is actually a recent webinar that we did with a Kiwi-based company for free of charge. Now, if you would like us to come into your workplace and talk about financial well-being, reach out via the link below. And remember that this podcast is actually best viewed on video.
Today's topic is how to make financial decisions in a world of inflation, rising interest rates, recessions, investment volatility. What should you do? So today we're probably going to spend 30 to 40 minutes talking. So for those who don't know Lighthouse, if it's the first time, we are a financial services firm in the middle of Auckland, but we have clients all over the country. We have accountants, mortgage brokers, and financial advisors. But our mission, quite simply, is to help Kiwis secure their financial future. What is the formula, you might ask, to secure your financial future? Education, which is what today is about, is first. But Mike, education by itself, it's not enough.
Yeah, look, it'd be great if all you had to do was sit down and watch a webinar once in a while, and that'd get you all the way to financial freedom. But it's not. You're going to hear us talk a lot today about taking action, right? And that action doesn't need to be something drastic like you need to go out and buy an investment property tomorrow. That's not what we're here to do. But it's more around what are the small consistent steps you can do over time to build towards that financial freedom. So again, education plus action, a little bit of time in the middle there will get you to that financial freedom. And that's what we're really talking about today.
Yeah, if you came here for a get-rich-quick scheme, fortunately, that's the next webinar. No, we're not doing that. We're not doing that today. It's all about, like Mike said, small, consistent steps to growing your wealth. Once again, for those who don't know us, this is our vanity slide, so we feel good about ourselves. We've taken a lot of people through these webinars, had a lot of good feedback, worked with a lot of big companies. So you've got us for the next hour. Please utilize us, ask us lots of questions, so you get out of today what you need to make the best decisions for your situation.
All right. So although, we are going to joke around a bit and give you a lot of information today, both James and I are financial advisors. So we do have to give a bit of a disclaimer. Now, just quickly, this is not personalized advice. We are just talking in general terms and providing information. We love the Q&A section, right? The more questions you ask, the more tailored this is really going to be to you. Like James said, everyone has a different level of financial knowledge. So to get the most out of the situation, please ask us questions. However, if you start asking us questions like, I'm 30, my partner's 32, we both own a house, what type of investment property should we buy? That is personalized advice. We are not going to do that on this call. I will come very close to doing it, but I will try not to actually step into the realm of personalized advice. We'll send out a link after the call, which basically just gives you the opportunity to book in a time with us. We're not going to charge for that time up front. So we can give you the answers to those more personalized questions during those meetings. First of all, we're going to give a bit of a market update. Now, it has been, and I don't mean to exaggerate here, a bit of a roller coaster over the last 24, 18 months, right? The market's been up, it's been down, it's going sideways, it's coming back, but we're going to discuss exactly what's going on in the market, why it's going on. We are technically still in a recession. So we will talk about some effective tools that you can utilize during a recession to try and get you through it if the cash flow is becoming a bit tighter on the household. We've seen, recently a lot of redundancies are coming through, especially in the government sector. So again, some tips and tricks you can do there. We're going to talk about the importance of having a plan. Everyone loves the fun stuff, right? We love the investment properties. We love buying the cars, investing in the share market, but we need to talk about what is the plan, how is it going to work, and what is the good thing about having one and putting one in place. I'll talk about what you can do with your mortgage if the cash flow is getting a bit tight. And then 2 questions we get asked in basically every webinar we do. Should I wait to invest or should I pay down debt and invest? And a lot of the time they're exactly the same question, but we will cover them off for you as well. And then we'll move on to our favorite bit, the question and answer section.
Okay, so let's talk about what's happening in the world. So Mike said it's been a bit of a roller coaster over the last couple of years, really, since COVID happened. I would say it's just been a roller coaster going in just like a downwards direction. At some point, it needs to go back up, but it just feels like it keeps going in one direction. So if we paint a bit of a picture, so let's go all the way back, Mike. Let me take you on a journey to the global financial crisis in 2008. Some bad stuff happened. There were some irresponsible people. But off the back of that, we had one hell of a run. property prices, share prices, economic growth, lots of good things were happening. From 2008 to 2020 were more or less good times. Most metrics, things were looking really good. COVID comes along, and we were well overdue for something bad to happen, where we move into property prices drop, share prices drop, a recession. We should have it about every 7 years or so. We were sitting more at like 12. And we're like, all right, guys, the music's going to stop. We're going to chill out for a little bit. But world banks were like, no. We want to keep that music going. So they dropped interest rates all the way to, 2%.
Negative in some instances.
Yeah, it was crazy. People were investing money knowing they were going to get less out, but they'd prefer that than investing it into the share market. So interest rates got dropped, which then resulted in sugar high lows, which meant lots of people went out and bought property, invested, started businesses. Things kept going really well until inflation came around. And so inflation peaked at around 7.5%. Interest rates on lending went from 2% all the way to about 7%, which caused a hell of a lot of pain. Property prices dropped, share prices dropped. And that all kind of started, probably about 18 months ago. And Mike, we probably by now would have thought we'd be through most of this, but it definitely feels like it's got quite a big tail to it, doesn't it?
Yeah, and basically the reason for that is, and usually the recessionary periods last for kind of around 18 months. We're a little bit further into that this time around, and basically that is because the hangover is so bad from those sugar high interest rates, right? If you think about interest rates in New Zealand, 2% is not a normal interest rate. 1.99% is not a normal interest rate, right? And we're seeing the hangover from that. And we had some really good news the other day with inflation coming down to 4%, but that is still outside the Reserve Bank of New Zealand's target inflation rate of between 1% and 3%. Why does this matter for households, right? A lot of talk about inflation, a lot of talk about the official cash rate. The official cash rate is the main tool that the Reserve Bank has to control inflation in the economy. Basically, they know that every time you get your salary and it comes in, the majority of the fixed cost that goes out is on your mortgage. So by lifting the official cash rate in a roundabout way, they lift the interest rate on your mortgage, which means you have less money to spend in the economy. Sounds like a really awful thing to do, and it kind of is, because it means they take all of the drive out of the economy. People stop spending. You're not going out so much. You're not buying clothes. The retail sector takes a hit. That then flows on to other sectors in the economy as well, and ultimately the manufacturing sector. And that means with less demand, prices should start to come down over time. There's a couple of different types of inflation, imported and domestic inflation. We're starting to see both of them. Yeah, I know I'm boring you, James. We're starting to see both of them come down to levels that are pretty close to that target band of between 1% and 3%. I am predicting that by the end of the year, we will see an official cash rate drop. I think it'll be the last official cash rate review in the year. We'll see them drop 25 basis points, really to give kind of some good economic indicators going into 2025. That doesn't mean you have to write this year off though, right? We have property at all-time lows. So if people are looking to buy houses, potentially, well, not all-time lows, but lows as of the recent property cycle. So all of a sudden now might be a good time to buy. But again, it is a tough time out there for people. So a lot of people are just trying to hold on.
Yeah, that's right. I mean, high interest rates, companies looking at redundancies, all that kind of thing means that we can be feeling like pretty down about where we are. However, you look at the share market and you think about your KiwiSaver. The share market, the S&P 500, top 500 companies in the US, up 31% over the past 12 months. Guarantee you have not seen that in a headline over the last year, but you will have seen that in your KiwiSaver. And it's a really good example that these bad times do not last forever and everything is cyclical. But the other piece is when you get out your phone, when you're looking at the news, when you're turning on the TV, clicks and views are not sold by positive headlines. They are sold by fear and from negative headlines. So while there are still some really tricky things we're not through, the reality is life is never 100% going to be roses, as I'm sure you've all worked out on this call before, but you can't make decisions on what's happening in the short term. Where is inflation right now? What is happening with interest rates? Should I wait another 6 months to buy a property? I'm not going to do anything because my uncle told me the world's going to end. We got to accept that there's never a perfect time to do anything. And we need to remove ourselves from a 6 or 12-month point in time and think much longer periods of time. What are my goals and what's the most efficient way to get there? So we're not talking about the market anymore. There's some things going on. The rest of this presentation is about what you should do.
Yeah, absolutely. And there's always going to be things going on in the market. Like James said, it's never the perfect time to do anything. At the top of the market, everyone's going to tell you you're overpaying. At the bottom of the market, everyone's going to tell you it's too risky, right?
So I'm keen to talk about what the people on this call should do. And Mike, we've got effective tools during a recession. People tend to focus on the wrong things, don't they?
Yeah, so we've graphed this out in a way where we think, the most effective to the least effective. A lot of people look at it in reverse. They start with things like, let's get a side income, let's make some extra income on the side. To be honest, we don't really rate that as a tool during a recession. We would prefer that you scrap that, double down on focusing on your work and making sure that your employment is stable and you're really performing well in your job. The reason I know these don't work is that most of the time when people have a side hustle and they apply for a mortgage, they have a small company registered. The bank sees that that company is registered. You are a shareholder and a director. It asks you to get the accounts for that. Most of them run at a loss. So then you might make 100,000 a year. All of a sudden you're running a 5,000 loss over here, and actually you're trading at 95,000 as your income instead. So again, in my experience, I don't think they work. They are not as effective as, say, having a plan and putting that into action.
Yeah. So side hustles, also like day trading shares, these accounts, none of that stuff really works. We really want to focus on having a plan. What are our goals? Putting numbers around them, reverse engineering them, which I'm sure everybody on this call will love. What are the consistent steps we need to take to achieve our goal? The budget's so important because your biggest asset is your income, and you can either float through life and not utilize it well, get to 65 and go, oh, that was a missed opportunity. Or you can use a budget effectively to pay down debt, to invest, to create options for yourself long term. And especially, Mike, which Mike will talk about in this webinar, when you're at 7% interest rate, you've got to have the right structure for your mortgages, or it can lead to a whole world of hurt.
100%.
Cool. So let's talk a little bit more about the financial planning side. So essentially, this is what we do at Lighthouse on the wealth side. Is people go, James, should I buy a property? Should I pay down my student loan? Should I get an investment property? Should I invest into shares? And my answer is always the same. It depends. What do you want? What are your goals? The person who is, and this is why it's so confusing when talking to friends and family and everybody doing so many different things. What is right for one person might be completely wrong for another person. Essentially, your money is just a tool to help you live the life you want to live, both short term and long term. And it's about finding that balance. So step one, you are on this webinar for a reason. I assume it's to take better control of your money. Step one is goal setting. What are the things you want in your life short term? What are the things you want in your life long term? Putting numbers around them, and then working out, how am I going to grow my wealth to get there? What's my strategy? Fundamentally, there's only three things you can do. You can pay down debt, you can invest into shares, or you can invest into property. They are the only three things you can really do. If you start a business, it's really just more income that flows into it. But if I was to say this in a safe space, because I feel like we can say we're all friends now, we've been together for a good 10, 15 minutes, taking action. I love engineers. Engineers, great group, very smart. If I was to pick a fault, over analysis, paralysis by analysis, should I buy this property? Should I buy this property? Property versus shares, all of these different options. If you are really smart, have good goals, had a bit investment strategy, but never take action, we're never going to go anywhere, are we, Mike?
Yeah, 100%. And we know a lot of really smart people who should be a lot more wealthier. And we know a lot of people who perhaps they're never going to be a member of Mensa, but take action quite quickly. And it's not, just throw it at the wall and see what sticks. There is a little bit of research they do, but generally speaking, time fixes most bad investment decisions. And if you're doing a bit of analysis and you're taking advice, the investment decision shouldn't be bad. It's when you don't make a decision and you don't take action, and we're still talking about it 2 years later, then it becomes an issue.
Yeah, this one's 1% better than this one, but because I'm not sure, I do nothing, which means I'm 100% worse off.
Yeah.
There's risk by making a decision. There's opportunity cost by not making a decision. So you need goal setting, a growth strategy, taking action, but then also reviewing your plan going forward. Life will happen. Your priorities will change. You have to tilt the plan around as you go.
Cool. So budgeting. Now, before everyone turns the webinar off at this slide, look, budgeting gets a bit of a bad rap. We're not here to tell you you can't go out, you can't do this, you can't buy clothes, you can't have fun. What budgeting is fundamentally about is, let's say I annualized all of those costs and I said, James, you spend 20 grand a year going out to dinner with your friends and going to bars. You might turn around to me and go, actually, Mike, that's fine. I enjoy that. I get utility out of it, and it's not stopping me from achieving my goals. In that instance, your budget is fine. It doesn't need adjusting. The issue would be if you weren't achieving your goals, or you weren't on track to achieve your goals, and that 20 grand was part of the reason you weren't. That's when we would need to adjust the budget, right? And to be honest, budgeting is pretty simple. Some money comes in, some expenses go out, you have a bit of fun, and there should be some savings left over at the end. That savings, that's what's getting you ahead, right? And you might, actually, to be fair, a lot of the time, the reason that people don't implement a budget is they go, I earn too much. I don't need a budget. A budget's for a different household, a lower socioeconomic status. That is not true. We have customers, we have a CEO who earns over $1 million a year and goes back every fortnight because the budget is terrible. You get that lifestyle creep, you get another pay rise, you spend more, another pay rise, you spend more. The budget isn't in place. They don't know their expenses and it all just disappears, right? I don't know. I don't spend heaps on food. I don't go out a lot, but I don't know where the money goes. If you take one action from today, why not do an audit of your accounts, look at what you're spending and put a budget in place? It's literally that simple.
Yeah. Your biggest asset is your income. And you have to use that income to invest into assets to then create more, passive income over time. So there's lots of different ways you can budget. If you've got a structure that works for you, then that's great. If you're coming to us and go, hey, what's the right system? We like the full mason jar approach with APs. And the idea is each fortnight when you get paid, money automatically gets filtered into these 4 accounts. The first account is the fixed expenses account. So if you do not know what percentage of your income goes towards fixed expenses, that is an immediate action off the back of this webinar. If you go, well, James, what percentage should I have? Well, it depends if you live at home with your parents or if you're a single mom. Like, they're completely different scenarios, right? What are your costs and what are your fixed expenses? Then, so we've got that. Then we've got to make sure we're saving money aside for an emergency. You need to be trying to build 3 to 6 months of expenses aside. If you do not have that set aside, you're going to end up using loans and credit cards with high interest costs that creates a bad relationship with money and really hard to get out of. Then most people, maybe including Michael Vincent, then jump to the fun fund. But the problem is the difference between a poor mindset and a wealthy mindset. You invest first and spend what is left over is what wealthy people do. Poor people spend their money and whatever is left over, they invest. So it's that prioritizing. And this is after your fixed expenses. Acknowledging there's a cost of living crisis right now, but that's not going to last forever, right? We know inflation's starting to come down. So making sure if your goal is, I know I need to save $1,000 a month for the next 2 years to be able to buy my first home in 24 months, are you putting that money aside? Because if you're not, you either need to make some changes to the budget or change your goal, because you don't want to set yourself up for a negative relationship with your money where you feel like you're never moving forward. And then the budget needs to be sustainable. So we do need to have some fun along the way. Like I said, it's a balance between enjoying yourself now and setting yourself up for the future.
Yeah, and like James said, not everyone is as good at managing their money or budgeting as other people. It's not a shtick. I'm not that good at budgeting, right? So my budget is super simple. I have automatic payments that are set up so I don't have to interact with my money. It means that literally the money goes into the account and I don't have to move it, because if I have to move it, I'm far more likely to look at it and go, savings is looking all right. Why don't I keep some more back for fun this month? So, if you are really bad at savings, have that savings account at another bank. Don't have a card linked to it. Make sure that there's as much barrier in between you and that savings account as you can possibly put, so that you still have access to it if you need it.
So, James, before we continue, I have got a special announcement.
Have you started sticking to your budget?
Absolutely not.
You finally made it as an after hours DJ.
I wish. Mate, the thing is, we have got a brand new podcast partner, Partners Life.
You mean the award-winning insurance provider with over 300,000 Kiwis insured?
Yep, they're also a New Zealand operated company, and they are passionate about increasing financial literacy amongst Kiwis.
Sounds like a great match. Where can I learn more about them?
Check out their website in our show notes below.
Really thought DJ Magic Mike was going to be a global sensation for a second.
All right, so about 50% of us on the call owned a house, which I assume means about 50% of us have a mortgage. If you don't, you're very lucky. Great time to maybe go again. It is
if you don't have debt, you should think about taking some debt.
Think about debt. It is no surprise that everyone is struggling out there at the moment. That is by the design of the Reserve Bank. Everyone is meant to be struggling, and my Lord, are they. With more redundancies coming down the pipe, it's not looking like things are going to get better for some people in the short term either. So you need to think about, if there is pressure on the cash flow in the household, what can you do to try and ease that? Now, everything that I'm about to run through is semi-technical jargon around things that you can do to a loan to try and improve that cash flow situation. You don't actually need to know what is happening and the best kind of decision to pick. If you outsource this and speak to a mortgage broker, you will get, I would like to think, good advice and the right products recommended and the right strategy for you. Now, I'm not saying you have to speak to me. I know my conflict of interest. I'm a mortgage broker, but I would highly recommend you speak to a broker over a banker, because we are financial advisors, which means we can give you actual advice and we can direct you to a number of products across multiple banks, not just one bank's product. But anyway, I'm going to rattle some off just so you get an idea of what we can do. You can extend the loan term. So if your loan term is at 20 years, you can potentially kick it back out to 30 years. That will lower the minimum repayment over time. You do need to watch this a little bit though, because if you're going past, say, age 60, 65, this loan shouldn't be hanging around that long. So you want to make sure that once those interest rates come back down to more manageable levels, you increase those minimum repayments again, right? So you're paying it off within a reasonable time period. And you don't want to be paying the minimum. So this is just a temporary fix. You want to make sure you're paying over and above that minimum over the long term. Yep, it may not be achievable right now. We're just hanging on. But once those interest rates start dropping again, end of this year, you should be able to, just keep chipping away at slightly more than the minimum. You could potentially put the loans onto interest only. So that's going to take out the principal portion of your repayment, and you will just be covering the interest cost on the loans. Max term you can do is 3 years on an owner-occupied property, 5 years on an investment property, and some lenders are going up to 10 years now in terms of the length of time period you can do it. This is an issue if you are planning on repaying these loans over a certain time period, right? The reason for that is, let's say I go on a 10-year interest only period and I've got 30 years to pay it off. Once I roll off that 10 years, I've only got 20 years left to pay it off. So my repayments are going to be significantly higher. So it is something you need to use, only when you need it. You don't want it hanging around for too long if it's your owner-occupied property. If it's an investment property, a little bit of a different story, although no one on the call has an investment property, so we don't need to cover that off. You can potentially look at the option of debt consolidation. Thank you, Ravi. I'm not finished yet. Where if you have short-term debt with higher interest rates, credit cards at 22%, personal loans at 25% or 15%, some type of asset finance around that 13, 14%, you can look at taking that debt and putting it against your mortgage. That will lower the interest rate, so say 22.5% down to 6, 7%. Huge saving there. And you can also extend the loan term. So that means your loan term goes from 5 years to 30 years. So your interest rate drops, your minimum repayments drop as well. However, this is a short-term fix. You should not have a car against a 30-year loan over your house. the value of the car will drop faster than the value of the mortgage. You'll go to sell the car and you'll still have some mortgage to pay off. So again, temporary fix, you need to make sure your repayment terms align with the depreciation of the asset. Offset or revolving credit, guys, this is basically if you've got any spare cash, you can use an offset or a revolving credit account, dump it in these loan accounts, and it means you're not paying interest on that portion of the mortgage. So in super quick terms, here's 4 really easy things that you can do to try and ease some of that cash flow pressure in that household. I will caveat this before Ravi shoots to the next slide though. If you think you are in danger of missing a mortgage repayment or falling behind on your mortgage repayments, or there is some chat in the office about some people getting made redundant, please, please, please speak to your banker or your broker sooner rather than later. The moment you go into arrears, the options we have start to shrink. And the further you go into arrears, or what we call delinquency, as soon as you're over, was it 14 days delinquency on those loans, all of a sudden we really only have 1 or 2 options, right? So please reach out, speak to your banker or your broker sooner rather than later.
Yeah, you definitely don't want to put your head in the sand. You want to understand your options. I think some people are scared, Mike, to
It's
talk.
embarrassing.
Yeah,
And
and
calling up a banker and being like, I can't make my loan repayment, right?
yeah.
It's a really terrifying thing and people are embarrassed. Lenders will work with you to try and make sure you don't have to sell the house and you're not going bankrupt, and try and get you through these periods. But you've got to speak to them. People put their head in the sand. They do not speak to them. They just think, oh, it'll all blow over.
Yeah, and while things won't blow over, it is important to remember this is just a point in time. If you are struggling, you just need to make sure that you are. I mean, the obvious one in addition to all of this is the budget. Maybe you didn't have to budget 2% interest rates, but a lot of people are having to budget 7% interest rates. So just making sure that you are, fully aware of what's going on. Now, Mike, that next example we're about to run through, I'm conscious it's an investment property example, and we don't have anybody on the call with an investment property. So I'll just give you that context and you can run into as much detail as you like with it.
Yeah, cool. So basically, this is a case study around 2 of our customers couldn't afford their loans, and the bank gave them quite bad advice and made some mistakes. And effectively, they went to the bank and said, our interest rates have tripled. You forgot to fix them for us. And now you're saying the rate is higher again. We can't afford these properties. And the bank's response was to sell one of the properties, right? They came to us just for a second opinion. Within sort of 15 minutes, we'd come up with a plan where we were going to refinance them away from their bank to Kiwi Bank, which means basically we can lock the interest rates up front. That was important at the time because it was when interest rates were just climbing. We put them back on interest only for 5 years. Their existing bank told them they couldn't have more than 5 years interest only, and it was running out. That's not true. You just need to reapply. They got 1% cash back from shifting the debt to Kiwi Bank. They used that money to bring one of the homes up to healthy home standard, and then we recommended that they rent that house out to Kāinga Ora. By renting to Kāinga Ora, it means they got interest deductibility, which is a favorable tax treatment on the investment property. And they went from being like negative 25,000 per year to I think they had to top up like $50 each or $100 each a week or something like that, which is much more manageable for those 2 sisters. So again, while the actual scenario around an investment property might not be specific to you because you don't have one, if you've got a mortgage and you're struggling, this is my example of go speak to a mortgage broker because we can give much more varied advice than a banker.
Cool. The other thing we get asked all the time, and particularly when markets are down, is I've got money to invest. Should I invest? Should I not invest? Should I wait 6 months? So we've got a case study from the year 2000 to the year 2020 with 5 different investing strategies where you had $2,000 to invest every year into the S&P 500, which is the top 500 companies. So Mike, let's talk through the 5 different investing styles, and then we'll talk through the results. And the idea here is what strategy is actually best.
Yeah, cool. Let's go look for look. So the 5 investing styles. First one, Peter Perfect has incredible skill. He's able to put his $2,000 into the market every year at the best possible time, which is the lowest closing point. Completely impossible to do.
Ashley Action does not muck around. The first day every year, she puts that $2,000 into the market.
Matthew Monthly divides it up into $2,000. Oh, sorry, it's $2,000 up into 12 equal allotments. and puts them in at the beginning of the month. We call this dollar cost averaging. It's basically what you're doing with your KiwiSaver.
Rosie Rotten is just as unlikely as Peter Perfect. She picked the highest point each year to invest, which is obviously the worst time to invest. So she's very unlucky, put a $2,000 in at the worst time every year for 20 years in a row.
Yeah. And then we've got Larry Linger. So Larry never quite gets around to investing. There's always another option to look at, another spreadsheet to compare with. So it means that he doesn't invest in the market and he keeps it all in savings. So there is a quiz. Ravi, can you pop it up? Which one of these investing styles do you think yielded the best results? Now, it is not a trick question, but I'm always fascinated to see basically the results.
Hey, we got a
Oh,
smart group. Peter Perfect is, as per the name, perfect. So whoever picked Larry Linger's, I think, taking the mickey a little bit. So here are the results over 20 years. So Peter Perfect has invested the best time every year for 20 years in a row. He's got 150,000 at the end. Behind is Ashley Action, investing immediately, and dollar cost averaging. Very simple. Obviously, if you invest $2,000 every year, that kind of is dollar cost averaging. Now, the two big, really interesting ones. Rosie Rotten. Rosie has picked the worst time 20 years in a row to invest. However, while it was a horrible time to invest at that day in the year 2000, you'd give your left arm to invest at that price point in the year 2024. So with a diversified investment, time fixes all wounds, really. The only wound it won't fix is Larry Linger, who is 3 times worse off than everybody else because he never got around to investing. He kept his money in cash, which has been eroded by inflation. Now, you might say to me, cash rates aren't too bad at the moment. I can make 6% in term deposits. Where's the inflation rate? Your money is still going backwards once you take into tax. And once inflation comes down and interest rates come down, term deposit rates will come down. So this is a really big thing is, the best time to invest was yesterday. The next best day to invest is today. You just want to think, nobody's smart enough to outperform the market. You just want diversification and time.
Yeah, absolutely. And it comes back to that point I talked about at the top of the webinar, right? Education plus action and a little bit of time equals financial freedom. We are not saying you have to go out and dump all of your money into the S&P tomorrow because today's the next best time to invest, right? What we're talking about is taking small, consistent steps over time to build wealth. This may mean that instead of dumping money in the S&P, you increase your regular repayment on your mortgage to pay it off a little bit earlier. You might get the budget sorted. You might spend 20 minutes on sorted.org looking at KiwiSaver providers, picking one that has, good returns, an ethos that you agree with as well, and some reasonable fees. That can mean the difference of hundreds of thousands of dollars at the end of your life when you want to use that KiwiSaver. We're not saying you have to take huge drastic actions. Everyone wants the sexy advice, right? They want me to be like, Mike, what should I do? Oh, I'll go use this iron butterfly spread on the stock market and NVIDIA stocks or something like that. It doesn't make any sense. You're just going to lose money. It's the small, consistent steps over time that are actually going to make a difference and actually get you to financial freedom. And if I sound pissed off, it's because everyone keeps talking to me about that stuff.
Just want
to pay off your mortgage.
Yeah. Cool. Mike, the other piece talking about investing over the long term, I think with both shares and property, we get too skewed with what's happened over the last 18 months, right? So pull us back in time. Tell us what's happened over the longer term with the property market.
Oh, absolutely, right? So, people really struggle to think about things on the long term. And theoretically, it sounds really easy to go, oh, yeah, the market moves in 7 to 8 year cycles. And, the old adage, buy low, sell high. If I said to you, today is the best day to go out and buy an investment property, the first thing you're going to think of, especially if you work in the government sector, is, am I going to be made redundant tomorrow? Interest rates are at an all-time high. No one's doing everything. All of the news out there is depressing. It is really tough to invest. Theoretically, what is the best way? We've got to look at things over the long term, right? And, we know that on average, property in New Zealand, basically doubles over 10 years, right? We use 5% in our predictions. We're not using any crazy 2021 numbers where it's jumping at, 20% per year. That's not what we're talking about. We're talking about what is the long-term average. Let's use 5%. We know that roughly every 10 years, things are going to double. That means if I buy an investment property today, do nothing with it, hold on to it for 10 years, I should get just about a double return on my money. Now, the reason we like property as an investment class is a couple of reasons. One, yep, there's some favorable tax treatment. Two, you have the ability to use the bank's money to grow the size of your investment, which we call leverage, to grow the return that you get, right? And yeah, someone might say you can do that in the stock market. You can to a degree, but eventually you get stopped out if you're trying to, really ramp up your leverage. So it is fundamentally a really good property class to invest in New Zealand over the long term, not financial advice.
Yeah, I mean, you just look at that long-term trend, right? And if you are thinking, in what I'm going to do is interest rates are going to come down and then I'm going to buy a property, can I tell you what's going to happen? So right now, property prices are low, interest rates are high. Interest rates will come down, property prices will go up. So if you do want to buy a house, it's quite simple. Do you want to pay a little bit more in interest costs right now, but make some decent capital gains over the next 12, 18 months? Or do you want to pay $100,000 more for the same house in a little while's time? Interest rates, along with the migration numbers and the fact we're not building many houses at the moment, I'm a little bit worried property prices are going to actually go up too much because that's not sustainable either. But let's move on to the share market. So long-term results for the property market. Like I said, long-term results for the share market. So S&P 500, top 500 companies in the US. Really important to think about, this over long periods of time, not really short periods of time. So 40 over 50 years, it's gone up in value. Average return of 10.9%. 18 years with a 20% or more gain. Only 3 years with a 20% or more loss. But why it's important to have a long enough period of time to invest. The other stat, Mike, because I like to freshen these up for you. Got another one for you today. Out of these 50 years, there's only been 3 years where at some point during the year, there hasn't been a 5% drop in the market, which means there's always volatility. Things are going up and down, but look at these long-term results of both property and shares. As long as you have the right time horizon, as long as you are diversified, the results speak for themselves.
Here is the question that we get asked in one way or another, basically in every webinar. And I haven't seen any questions go in the Q&A section yet. So if you have any questions about what we're asking, what we're talking about, or your financial situation, they're anonymous. Put them in the Q&A section and we'll answer them at the end. Now, should I pay down debt or invest? You can ask this in a number of different ways. Mike, should I increase my KiwiSaver contributions or should I pay down my mortgage? Mike, should I invest in a Sharesies account or should I pay down my mortgage? Effectively, all you're doing is asking the same question using different widgets, right? So when interest rates are 2%, this is a little bit of a trickier question to answer. However, at the moment, this is a stone cold, very straightforward answer. You should pay down your debt before you invest at the moment. The reason being is when you are looking at the headline investment rate and the headline interest rate that you are paying on your mortgage, you are not comparing apples for apples. You are comparing a gross return for a net interest rate. Let's break that down a little bit. So let's say I'm getting 7% on my investment portfolio at the moment. I need to take off tax, fees, and inflation because I'm not spending the money straight away. Very quickly, that net return will be under the interest rate that you are paying on your mortgage. So you are better off to pay off your mortgage first and then invest. There are variations around this where at some point it might be better for you to get an investment property, but generally speaking, you should be focusing on paying down that mortgage.
So if you want to have a chat to the wealth team about building a financial plan, you want to talk about KiwiSaver, you want to make sure you got the right insurance, you want to talk about your wealth creation strategy, you can scan the QR code there to have a chat about whatever's on your mind. Happy to talk to you, see how we can help.
And if you want to have a chat to the mortgage team, so for the 50% of people who do own a house, you might want to talk about, is your current interest structure correct? Should I adjust the structure? Is the bank right for me? Are my products correct? Am I on the best interest rate? Are there ways that I can pay off my loan faster? For those, or maybe is the right time for me to buy an investment property now? Do I have enough equity and income to buy while the market's down? For those of you who don't have a property, you might be asking me, When can I get on the property ladder? Is there a strategy I can get onto the property ladder a little bit quickly? I want to get on the property ladder now. Can I buy? We can run the numbers, go get you the pre-approval. And in some instances, people are generally just wanting to look at their portfolio of properties, although that's not really so much for people on this call because we don't have 2 or 3 houses. We can talk to you about anything about property. We can give you advice on mortgages, properties, loans, interest rates, structures, all of that sort of good stuff. If you feel like booking in, scan the QR code or we'll send out a link after.
So we do have a couple of questions starting to come through.
Can you please explain how the tax system works for investments in the US stock market? Do I need to pay tax every time when I sell stock? I know nothing about this. This is definitely you.
Yeah, and I'm not an accountant either. However, let me ask a question from your question. Why are you picking US stocks? Like, what is the logic there? May I suggest, if you are not familiar with investing or have not invested a truckload of time into it, just pick a really good diversified fund. You can find ones that are, Kernel's got a high growth fund if that's the right risk profile for you. I wouldn't go in. I don't like people picking direct stocks. The answer is a lot of it is to do with like, what is the purpose of buying the stock? So if it was bought with the intention to sell, and it's US stocks, then yeah, you're probably going to pay some tax. But I would just be investing into something diversified, matching your risk profile, and they will always deal with the tax, so you don't have to worry about it. Next question. I think this is a mortgage question, Mike. So let me see if I can redeem myself. Currently just bought fixed half, and the other half is floating to reno the house. Very interesting. When should I refix the floating, or always just try to pay down the floating and keep the facility?
Depends how big the loans are. If you're doing serious renovations on the house, let's say you've got $1 million mortgage, 500 was for the purchase and 500 is for the renovation, you should be fixing chunks off that 500K as you're using it. So if you use 100 grand, fix 100 grand down, 50, just in kind of regular intervals. So you're not paying a floating interest rate on that whole mortgage. And then I guess the other thing is it depends how quickly you want to pay it off again. Having a large block of funds on a floating rate, say more than you could reasonably pay off in a year, doesn't make a lot of sense because you can fix that portion of the loan for a year. Or let's say you got 100 grand in floating, you're going to pay off 20K this year outside of your other mortgages. You would fix 80 grand and leave 20 grand on floating. You've just saved probably about 2% in interest on that whole 100 grand, and you still retain the access to just keep hammering away at that floating interest rate. Other little things to consider there are the bank that you're with, the rates, what the market is doing. But generally speaking, I would say fix portions of the loan and pay off, reasonably speaking, just leave floating what you can pay off within a year. Yeah. But then if you're still doing the renovations, you got to take that into account as well.
If you have a topic that you would like us to do, please let us know. If you want to have a chat to us one-to-one about your mortgages, about financial planning, you need accounting support, make sure to reach out to us. As we close this webinar, a survey link will pop up, and we'll also send that out via email. Please, if you can fill that out, we want to know if we're doing a good job adding value, or anything we can change to make these better. So thank you very much, everybody. We will catch you next time.
Cheers.